Breaking news on Martyn Lucas Investor. We are looking at why is your portfolio not at an all-time high when the S&P 500 is, and I'll give you the data around that. So thank you for tuning in. This is going to be a special video. Please do watch until the end. There's basically three reasons why. One is you're probably not in the US. So you can see a chart here. This is from our newsletter. Every single day we do a newsletter. Today's main story, the deeper dive section, we had 5 main stories of the day, plus this is about this story that I'm bringing to you as a video. You can see this is a chart of the Vanguard S&P 500. That's VUSA. That's the UK version of VU. And you can see that is up 22% since January of 2024. But then in pink here, you have VU, the US tracker of the S&P 500. And that is up around 32%, so about 10% more. And I'm going to tell you why you need to be careful of this. So this chart shows a clear divergence since January of 2025. Vanguard's S&P 500 ETF in Great British Pounds, ticker symbol VUSA, is up 22%, while its USD counterpart VU has gained 32%, a full 10% difference on the same underlying index. Everyone's saying the S&P 500's is at all-time highs, but maybe not for you. So more recently, since January of this year, VUSA is actually down 3%, while VU is up 5.5%, once again reflecting a near 10% performance gap driven purely by currency effects, currency impact, the hidden tax on international SPY returns. So a roughly 10% decline in the US dollar during 2025 has created a disconnect between headline S&P 500 performance and the actual returns seen by global investors. Although the index is up 5% year to date in USD terms, those gains have been largely offset or reversed. We're actually down in the UK 3% for investors abroad, so not just the UK, Europe, other countries as well, abroad due to currency headwinds. For those holding unhedged positions, especially in countries like the UK, the weakening dollar has significantly eroded real returns. UK investors bear the brunt. British investors, for instance, have seen the pound surge to $1.37 from around $1.22 at the start of the year, a nearly 13.7% appreciation. That strength has erased any S&P 500 upside in Great British pound terms. The dollar index has also dropped to the 97 mark, making it the worst half-year dollar performance in over 50 years. That is a big piece of data for you guys. Worst first half dollar performance of 50 years. People in the US holding the S&P 500 are at all-time highs. People holding it in the UK are actually down on the year, and pretty much nowhere near all-time highs. So since UK investors must convert their pounds to USD to buy US stocks like ETFs like SPY or VUSA, they have taken a direct hit. A stronger local currency makes your US denomination holdings worth less when converted back, a drag many overlooked when assessing portfolio returns. You need to be understanding currency risk, and I'm not telling you to do something now, it's probably too late, but you need to take this into account in the future. Currency risk is certainly a risk, and if you're not hedging your position, then there is an issue. In the UK, you go onto Trading 212 or wherever and you buy US stocks, your money in pounds gets converted to dollars and then you buy it. And then you have that whole currency risk as well. And a lot of people have been basically seeing stocks up 10%, but in real terms, their FX returns are down 10%. Why? Because the currency risk there, and you're not even up on an asset that's actually up. So take that into account. So the growing hedge response, as a result, institutional investors are adapting. 10% of Russell Investments European clients have increased their hedge ratios on their equity portfolios. One large fund moved from 50 to 75% hedge exposure. Meanwhile, SPDR ETFs now offer cost-efficient currency hedge share classes, often adding 0 to 5 basis points in costs. For international investors, ignoring FX risk can be more costly than market volatility, especially in low return years. Another reason you might not be at all-time highs is you're probably choosing individual stocks. The concentration reality check. Another reason your portfolio may be lagging the index is you're likely not even holding the index. The S&P 500 record-breaking concentration means that gains are being driven by a handful of stocks while most others lag. The Magnificent Seven outsized impact. By early 2025, the top 10 companies made up by nearly 40% of the S&P 500, up from 26% during the dot-com bubble peak. Apple 6.9%, Microsoft 6%, Nvidia 6% alone nearly comprise 20%. This means that the vast majority of the market is not participating in the rally. While the cap weighted index is up 5%, the equal weighted S&P 500 is flat to negative. So you've got the S&P 500 version where it just tracks all 500 in an equal weight, and that's actually down on the year. So you can see that you're probably down because most of the other stocks are actually down, whereas the Magnificent Seven are up and they're making up most of the gain. So if you're holding the Magnificent Seven, you might actually be up more than the S&P 500. If you're holding the other parts of the S&P 500, you're probably down as well because of the way it works and how individual stocks are underperforming the Magnificent Seven. So over the 5 years, the gap is even wider, 110% total return for cap weighted versus 84% for equal weight. You can see that the weighted S&P 500 outperforms the equal weighted S&P 500. And that just gives you an idea of what individual stocks holding means versus holding the S&P 500. So the breadth problem. Under the surface, most stocks are bleeding. The 9 smallest S&P 500 companies are down an average of 20% in 2025, with a median drop of 19.3%. Even mid-sized names outside the tech elite are mostly flat. While mega caps absorb all the passive flows, individual stock pickers are swimming against the tide. Historically, this level of concentration has signaled poor forward returns. During the last two extremes, 1980s and 2000, the top 10 names subsequently underperformed the broader market, and only Microsoft outperformed long term after a 19-year drought. So again, that is about individual stocks. That might be another reason you're down. So even for the people in the US, the dollar devaluation, you might say, well, I'm at all-time highs. It's great for me. Well, don't forget your currency is getting devalued. So the dollar devaluation, the erosion of US purchasing power, even if you're in the US, sitting on a portfolio highs, the dollar decline still matters. The DXY's multi-year low is quietly eroding real returns and buying powers, both domestically and abroad. Inflation and real returns. Inflation is stable but persistent at 2.35%. A 5% portfolio gain only nets a real return of 2.65. Add margin on top of that. If you're paying 4% for margin, a normal year of the S&P 500 it completely eroded. So keep that in mind. And as the dollar weakens, imports and globally priced commodities become more expensive, especially gold, which has spiked to $3,300 an ounce. And JP Morgan is forecasting that to go to $3,675 an ounce. Don't forget, gold is not just going up for the sake of gold going up. It's going up because inflation is persistent. You've got dollar being devalued, and you've got geopolitical concerns. So that's why I always said gold is a vital part of people's portfolios. Again, that's not financial advice, that's just what my thoughts are. That means that the dollar has lost nearly 25% of its value relative to gold, a hard asset barometer for long-term wealth retention. Gold is the standard of purchasing power. If you want to keep your purchasing power, gold is the standard that's been used for thousands of years. So, global purchasing power erosion. This also affects American consumers abroad. Foreign travel, global real estate, and international investing are now more expensive. The weaker dollar functions as a hidden tax on global lifestyle and investment optionality, particularly for retirees and high net worth individuals with global ambitions. The Fed policy and structural headwinds. The Fed expected 175 basis point cuts in rate cuts over the next year are central for currency decline. Lower rates reduce capital inflows and suppress demand for US debt and equities. Reuters FX survey shows nearly 90% of strategists expect the continued dollar selling. The era of USD strength might be fading. So this is something that analysts are saying rate cuts are coming. That's going to bring the dollar down, and 90% of strategists are saying that the dollar is going to continue selling off. So keep that in mind. So the conclusion. The S&P 500 is rising, but the story under the hood is more complex. For international investors, currency depreciation offsets market gains. For stock pickers, index concentration hides the reality that most stocks are flat or down. And for US investors, the dollar's devaluation quietly erodes real purchasing power. Investors must recalibrate, hedge selectively, diversify across asset classes and geographies, and understand that real returns, not nominal figures, are what truly matters. I thought this was a very important story to bring to you all. And while this is being made and this is all from the newsletter, so the link for the newsletter is in the description below. It is the first link in the description, so please do go ahead and sign up to the newsletter. Not only do you get these deeper dive stories, you also get the market snapshot. You get the 5 things you need to know, what's happening every single day. It's a daily newsletter with charts, with top stories and everything you need to know if you're an investor in the market. So please do check that out as well. We also have a poll running in this is made during a live video. A poll is running. Is your portfolio at an all-time high? And I've got 4 options. One is yes, and you're in stocks mainly, that's 31%. No, stocks mainly 9%. Yes, crypto mainly 24%. No, crypto mainly 36%. So we've got about 50% of our live viewers, and that's about 171 votes so far, that are at all-time highs, and 50% that aren't at all-time highs. More of the people that are at all-time highs are holding stocks, and probably the S&P 500 index. But please do remember, if you aren't in the US and you are seeing that everyone's saying the S&P 500 is all-time highs and you're not, it's because the dollar's being devalued, and that is why you're not at all-time highs. That FX toll is pretty big, especially with the dollar down and expected to continue going down. The other reason might be is you're picking individual cryptos and stocks, which most of the time underperform the S&P 500. If you're picking stocks, you've just seen in that report that most of the other parts of the S&P 500 are down quite significantly or flat, and the Magnificent Seven are propping up that index. So keep that all in mind, and going forward, you can make sure you are hedged against currency risk. For example, that is the poll right there, and that's the results. Thank you for tuning into this video. Until next time, take care of yourselves and each other. There'll be 2 videos up here.